The market does not ring a bell when the right entry appears. It whispers. Most traders miss that whisper because they are watching every tick, hunting for action instead of waiting for evidence. Have you ever noticed how the best opportunities often begin when the crowd is still uncertain? I learned that price itself must do the talking. A hidden entry signal is not some mysterious indicator. It may be a stock holding firm while the general market weakens, a breakout that refuses to fall back, or a pullback that dries up near an important level. The point is not to predict. The point is to observe how price behaves when it reaches a place where something should happen. Suppose, hypothetically, a stock pushes through resistance, returns quietly to that level, and buyers appear again. Would you rather enter because you feel hopeful, or because the tape has given you something definite to measure? That difference matters. Good speculation is built on confirmation, patience, and controlled risk. Money is made by protecting capital long enough to recognize the larger move. A trader who wastes his account on weak setups has little ammunition when the strong one arrives. Wealth in speculation grows from discipline before it grows from profits. And remember this, sometimes the signal is hidden because you are looking too hard. Sometimes the market is telling you something by what a stock refuses to do. The averages weaken, selling spreads, and most names begin slipping with them. Yet one stock holds its ground. It may bend a little, but it does not behave like the others. That difference is worth your attention. Why? Because weakness in the general market creates pressure. Under that pressure, stocks with little real demand usually reveal it. They fall because buyers step aside. But when a stock remains firm while conditions around it deteriorate, somebody is still willing to support it. You are not guessing that strength exists. You are watching strength survive a test. That does not mean you buy simply because a stock is green on a bad day. The important question is whether the firmness persists. Does it repeatedly recover when the market pushes lower? Does selling in the broader tape fail to produce the weakness you would normally expect? The longer that difference remains visible, the more meaningful it becomes. This is where many traders make the wrong comparison. They judge the stock only against its own previous price. A better observation is to ask how it behaves compared with everything being hit around it. Relative behavior can reveal demand before the chart looks exciting. And once you learn to notice what refuses to weaken, another question appears: what should you think when weakness does appear, but cannot hold? A clean break below support often looks convincing because it gives traders exactly what they expect to see. Stops are triggered, sellers become confident, and the chart appears to confirm that weakness has taken control. But the important part is not that support broke. It is what happens after the break. If sellers truly have control, price should continue lower. The break should produce progress. When that progress does not come, the meaning begins to change. Price slips under the level, hesitates, then climbs back above it. Now the traders who sold the breakdown are holding positions that are no longer behaving as expected. This is where psychology becomes visible in price. A trader who entered short below support may wait at first, hoping the decline resumes. But as price recovers, discomfort grows. Some cover their positions. That buying can add pressure to the recovery. The failure of the bearish move creates fuel for the opposite side. Would you rather act on the first dramatic break, or wait to see whether the market can actually stay there? That question separates reaction from observation. The practical signal is not simply a dip below support. The important event is the reclaim. The market proving that lower prices could not hold. But even that reclaim still leaves one question unanswered. After price recovers, can it defend the level it just won back? A breakout can tempt you into thinking the decision has already been made. Price clears resistance, momentum appears, and suddenly everyone wants to be involved. But the first burst often tells you less than the return that follows. When price comes back toward the old resistance area, the market is testing whether that breakout changed anything. Sellers now have another chance to push price back into the former range. If they cannot do it, the level begins to carry a different meaning. What once stopped buyers may now be a place where selling loses force. That changes the quality of the decision. Chasing the first move means buying while emotion is strongest and distance from the level is greatest. Waiting for the return gives you something more useful evidence. Can price approach the old barrier without collapsing through it? Can buyers appear before the breakout is fully surrendered? The hidden signal is not the breakout itself. It is the market's ability to revisit the scene of the breakout and remain structurally changed. You are no longer asking whether price can get above resistance. You are asking whether it can stay above it when challenged. Watch that second test carefully. Sometimes the most important clue is not how far price moves, but how quietly the next battle begins. There are times when the market becomes strangely quiet. The wide swings disappear. Each push travels a little less distance than the one before it. Traders often lose interest at that point because nothing dramatic seems to be happening. But shrinking movement can itself be information. A market needs opposing pressure to keep producing large swings. When those swings contract, neither side is getting the same result from its effort. Buyers cannot drive price far upward, but sellers cannot force much ground lower either. The available room for disagreement is becoming smaller. That matters because a compressed market is storing a decision, not announcing one. The mistake is to assume that quiet price action predicts direction. It does not. Compression only tells you that the current balance is becoming unusually tight. Direction must still be proven by what happens when price finally escapes that narrowing structure. So what should you watch? Look at whether each reaction becomes smaller, whether the range continues to tighten, and whether price stops producing the violent reversals that kept traders uncertain before. The signal is not excitement. It is the gradual removal of noise. Most traders notice expansion after it begins. The sharper question is whether you can recognize when the market is running out of room before that expansion arrives, and what it means when price begins spending more time near one particular boundary. A resistance level can look powerful the first time price reaches it. Buyers push up, sellers answer quickly, and price is driven away. That first rejection tells you the level matters, but the more useful information may come from how that rejection changes on later visits. Suppose price returns again. This time sellers still respond, but they cannot force it as far away. Then price comes back once more and begins spending longer near the same boundary. Nothing has broken yet, but something has changed. The sellers are still defending the level, yet their ability to create distance is weakening. Ask yourself, if resistance were truly becoming stronger, shouldn't each test produce a stronger rejection? When the opposite happens, the chart is showing you that price is becoming more comfortable near an area that once caused immediate retreat. That is the hidden signal. Not the number of touches, but the quality of the reaction after each touch. You are measuring rejection. Strong rejection creates distance. Weakening rejection leaves price nearby. So watch what happens after contact. Does price get thrown back sharply, or does it return quickly and remain close? The longer the market can stay near a boundary without being pushed away, the more attention that boundary deserves. And sometimes the next clue comes not from distance at all, but from how much trading occurs without producing much movement. Heavy volume attracts attention because traders assume something important must be happening. But volume by itself tells you only that a great deal of business is being done. The deeper question is simple: what result did all that effort actually produce? Imagine strong selling hits a stock. Activity expands sharply, yet price barely moves lower. That is different from ordinary weakness. If sellers are truly in command, greater pressure should create greater downside progress. When the effort increases but the result does not, another force is meeting that supply. This is where absorption becomes important. Every aggressive seller needs a buyer on the other side. If large amounts of stock change hands without much decline, somebody is willing to take what frightened holders are offering. You cannot know their intention with certainty, but you can observe the effect selling is failing to move price as expected. Would you rather react to the size of the volume, or ask why all that volume achieved so little? That question changes the way you read the tape. The practical task is to compare effort with result. Heavy activity with strong movement confirms pressure. Heavy activity with little movement tells a different story. It suggests opposition is present, and that opposition deserves watching. Then comes a harder test. What happens when new information arrives and price refuses to respond the way everyone expects? Bad news usually carries an obvious expectation. Traders hear disappointment, weak guidance, or an unfavorable announcement, and they expect price to fall. Sometimes it does. But the more interesting situation is when the news sounds damaging and the market refuses to behave as though it is damaged. That refusal matters because markets trade expectations, not headlines alone. If everyone already feared bad news, much of that fear may have been reflected in price before the announcement arrived. When the event finally appears and selling cannot produce fresh weakness, the reaction tells you something the headline cannot. This is where many traders become trapped by interpretation. They decide what the news should mean, then ignore what price actually does. But what is more useful to you? The opinion formed from the announcement, or the market's response after thousands of participants have acted on it? The application is simple but demanding. First, define the expected reaction. If the information is clearly negative, you would normally expect lower prices. Then watch whether that expected weakness appears and persists. If it does not, the failure of the expected response becomes the information worth studying. You are not buying because bad news is secretly good. You are watching for a mismatch between expectation and behavior, and once that mismatch appears, the next question is whether strength is isolated or beginning to show up elsewhere. Sometimes the clearest signal for one stock appears somewhere else first. A leading company in an industry begins advancing, then another strong name in the same group follows. Meanwhile, a third stock remains quiet beneath an important area. On its own, the chart may look ordinary. Inside the group, it may deserve closer attention. Markets often move through leadership. Capital does not enter every stock at the same moment. It tends to show preference first, then spread if the underlying theme attracts broader participation. Because of that sequence, the first movers can provide context for names that have not yet moved, but this requires judgment. A lagging stock is not automatically an opportunity. Sometimes it lags because it is genuinely weaker. The useful question is whether its own structure remains constructive while stronger peers are already confirming demand for the group. If the leaders keep advancing and the quieter name begins responding, the sequence becomes meaningful. Would you rather discover the group after every chart looks obvious, or notice where money appears to be concentrating before the entire group reacts? The point is not to copy the leader. It is to understand what leadership changes about the chart you are considering. Watch the order of movement. First one name, then another, then perhaps the one on your screen. But even a well-read sequence can produce a failed first attempt, and that failure creates a completely different decision. A stopped-out trade creates a dangerous moment, because the market is no longer the only thing influencing you. Now there is a loss attached to the chart. That loss can make a second entry feel like a chance to correct the first one, and that is where judgment becomes clouded. A re-entry should never exist because the previous trade failed. It should exist because new evidence has appeared. The first setup is finished once you are out. If price later stabilizes, rebuilds its structure, and produces a fresh trigger, you are not continuing the old trade. You are evaluating a new one. Can you look at the chart as if you had never traded it before? That is the real test. If you would not enter now without the memory of the loss, then the urge to re-enter is probably emotional rather than analytical. This distinction matters because revenge trading begins with cause and effect in the wrong order. The loss creates frustration, frustration creates urgency, and urgency searches for justification. A sound re-entry reverses that chain. New market behavior appears first, then you decide whether it deserves capital. So after a failed attempt, remove the old story. Wait for a new reason to exist, and before that next order is placed, another question becomes unavoidable. Can you define exactly what would prove the new idea wrong? A chart can look attractive and still offer a poor entry. The reason is simple. If you cannot tell where the idea becomes wrong, then you are not really measuring a trade. You are only expressing an opinion with money attached to it. A strong entry has structure around it. Price reaches an area where your thesis has a clear test. If that structure fails, the market has given you useful information. Because the failure point is visible before you enter, the amount of uncertainty can be considered before capital is committed. Ask yourself this: if the trade turns against you, what exact market behavior would tell you that your original idea no longer deserves confidence? If the answer is vague, the setup may be exciting, but the entry is weak. This is why location matters. A modest setup near a clearly defined decision point can be more useful than a dramatic move in open space. Clear invalidation does not make the trade safe. It makes the risk understandable. That distinction protects the trader from turning a market thesis into hope after entry. The application is to judge an entry by more than upside possibility. Judge it by whether the chart gives you a specific place where the premise breaks. And once that line is clear, the next detail becomes important. What does the market reveal by where it chooses to finish the day? A trading day can frighten you long before it tells you the truth. Price may break sharply in the morning, recover, weaken again, and leave traders reacting to every swing. But by the close, much of that noise has been settled. What remains is where the market was willing to finish. That finishing position matters because the close reflects commitment. If price spends the day under pressure but ends near the session high, buyers have taken back ground that sellers once controlled. The early weakness was real, but it was not permanent. By the final part of the session, the balance had changed. Would you judge that day by its worst moment, or by who controlled the market when time ran out? That distinction can alter how you read the entire session. A close near the high does not guarantee strength the next day. Its value comes from comparison. If sellers had repeated chances to keep price depressed and failed to do so, their inability to hold the advantage becomes information. The market has shown that lower prices attracted enough opposition to reverse much of the damage. So when you study a daily bar, do not look only at its range. Notice where price finished inside that range and what had to happen for it to get there. Then watch the next decline carefully, because a healthy market often reveals itself not by avoiding pullbacks, but by the way those pullbacks behave. A rising market does not become weak simply because it pulls back. The real question is how that decline behaves. Some corrections fall with urgency. Others seem almost unwilling to move lower. That difference can tell you more than the fact that price is red. When sellers are gaining real control, the decline usually begins to make progress. Each push carries farther. Reactions become sharper, and price spends less time recovering lost ground. But when a pullback drifts lower in small, overlapping steps, the selling is producing very little reward for the effort. That matters because a correction can happen through time as much as through price. A market may need to pause after an advance without giving back much territory. If sellers cannot create acceleration during that pause, the larger move may still have underlying strength. Would you rather fear every decline or ask whether the decline is actually becoming stronger? That question keeps your attention on behavior instead of emotion. Watch the sequence. Is each downward push expanding or losing force? Are sellers gaining distance quickly or needing more and more time to achieve less? A slow, reluctant correction does not promise another advance, but it tells you that the opposition has not yet taken command. And sometimes the next important clue comes when price briefly crosses an obvious level, attracts attention, and then does something entirely different. Obvious highs and lows attract attention because many traders see the same thing. Orders collect around them. Stops sit beyond them. Breakout traders wait near them. And that concentration of interest can make the first move through the level look more important than it really is. Suppose price pushes above a well-known high. The move triggers buying, stops are activated, and momentum suddenly appears. But then something changes. Price cannot continue. The burst of activity produces very little additional progress, and the market slips back inside the old range. That sequence matters because the break may have found liquidity rather than genuine acceptance. The orders beyond the level helped create the surge. But once those orders were filled, Fresh demand did not continue the move. Cause and effect have changed. The breakout looked strong because orders were triggered, yet the failure to extend reveals that the strength may have been temporary. Would you buy simply because price crossed the obvious line, or wait to see whether it can live beyond it? The practical lesson is to study what happens after the sweep. A brief move beyond a visible level means little by itself. The important information is whether price can remain there and keep making progress. And even that signal can change meaning depending on where the same move sits on a much larger chart. A small pattern can look perfect and still mean very little. The same 3 or 4 bars may appear hundreds of times on a short-term chart. What gives that pattern importance is not its shape alone, but where it appears inside the larger market structure. Imagine 2 identical setups. One forms in the middle of a broad, directionless area. The other forms near a major weekly turning point the traders have respected before. Visually, the entries may look the same. Structurally, they are not the same trade. The larger time frame provides the location. The smaller time frame provides the evidence. When those two agree, a minor change in price behavior carries more weight because it is happening where a larger decision is already possible. Ask yourself, are you trading the pattern, or are you trading what the pattern means in that location? That distinction matters. A lower, time frame signal without context can become nothing more than chart decoration. The practical work is to start wide, then move closer. First identify where price sits on the larger chart. Only then study the smaller action for evidence that behavior is changing there. The smaller signal becomes useful because the larger map has already told you why that area matters. And sometimes that larger change in value happens before the regular session even begins, leaving an empty space on the chart that demands a different kind of reading. A gap changes the chart before the regular session has even had a chance to speak. Price opens far from the previous close, and traders immediately see movement. But the gap itself is not the hidden signal. The important information comes from whether the market accepts that new territory. Suppose a stock opens sharply higher. Once normal trading begins, sellers get their opportunity to push it back toward yesterday's range. If price quickly returns and closes the empty space, the overnight repricing has lost much of its authority. But if repeated selling cannot pull price back, the market is showing that participants are willing to conduct business at the higher level. That distinction matters because a gap creates emotion before it creates evidence. Traders see the distance and feel compelled to act. Yet what should matter more, the size of the opening jump or the market's ability to defend it once real two-sided trading begins. Watch how price behaves around the lower edge of the new range. Does every attempt to retreat gain ground, or does price remain separated from the old territory? The longer the gap remains defended, the more seriously you should treat the possibility that valuation has shifted. You are not assuming every unfilled gap must continue. You are observing whether the market accepts the repricing. And once one market accepts a new price, another question appears: do the markets connected to it confirm the same message? Two markets can tell a clearer story together than either one tells alone. When instruments that usually respond to the same forces begin moving differently, that disagreement deserves attention. Suppose one related market makes a fresh low, but the other refuses to follow. At first, the new low may look like confirmation that weakness is increasing. Yet if the companion market holds above its own low, the move is missing something it normally receives agreement. That does not mean divergence predicts an immediate reversal. It means the apparent strength of the move should be questioned. If the same underlying pressure is truly becoming stronger, why is one market no longer responding? The failure to confirm can expose a change in conviction before the first chart shows anything obvious. This is where patience matters. Do not trade every disagreement between two charts. First understand whether the relationship is meaningful, then watch whether the divergence persists as price tests the extreme again. A brief mismatch can be noise. A repeated refusal to confirm carries more weight. The application is to treat related markets as witnesses. When both tell the same story, confidence in the move increases. When one stops agreeing, the evidence becomes less complete. And sometimes the most revealing failure is not between two markets at all, but between a trade and the amount of time it should need to work. A trade can remain technically alive while quietly losing its reason to exist. Price has not hit the point that proves you wrong, yet the movement you expected simply does not arrive. That delay is not always harmless. Every setup carries an implied rhythm. If a break is supposed to reflect strong demand, you expect some degree of follow-through. When price triggers, stalls, and spends too long going nowhere, the original imbalance may be weaker than it first appeared. Time has begun to contradict the idea. Ask yourself, if the setup was truly urgent, why is the market showing no urgency? That question is different from impatience. Impatience comes from wanting action. Time analysis comes from comparing actual behavior with what the setup logically suggested should happen next. The danger is psychological attachment. Once you enter, you may defend the trade simply because price has not forced you out. But absence of failure is not the same as evidence of strength. A market that cannot progress gives opposing traders more time to respond and weakens the original premise. So watch not only where price goes, but how long it takes to get there. A good idea can deteriorate through delay before it deteriorates through price. And nowhere is that timing more revealing than at the opening, when expectations collide with the first real wave of orders. The opening can make a weak idea look powerful. Overnight expectations have built up, orders are waiting, and the first few minutes can produce a sharp move that feels decisive. But the opening push is only the first opinion expressed under full liquidity. Suppose price opens strong and immediately runs higher. Buyers chase the move because they assume the strength will continue. Then price stops advancing. The next push cannot make meaningful progress, and sellers begin forcing it back through the opening area. What looked like confirmation has become rejection. That reversal matters because the first move attracted commitment. Traders acted on the opening's strength, yet the market could not reward them with continuation. When early momentum fails under fresh two-sided trading, the original expectation loses authority. Would you rather react to the speed of the opening move, or wait long enough to see whether the market can defend it? The second question gives you information the first minute cannot. Watch the relationship between the initial push and the response that follows. If the market quickly gives back the ground it fought to gain, the opening direction may have been emotional rather than durable. The signal lies in who controls price after the first excitement fades. And sometimes, after that opening struggle is settled, price does something even more frustrating. It goes nowhere for far longer than traders expect. A market can spend days doing almost nothing and still be changing underneath. Price moves back and forth inside the same area. Each attempt to escape fails, and impatient traders begin treating the range as wasted time. But time inside a base has its own function. After a strong move, ownership has to change hands. Some traders are taking profits. Others are entering late. New buyers are building positions while discouraged holders are leaving. Because these groups have different motives, price can remain trapped, even though the people holding the stock are gradually changing. That is why a base should not be judged only by its shape. Ask yourself what repeated failure to leave the range is doing to the participants inside it. Each false start tests conviction. Each return frustrates traders who expected immediate movement. Over time, those unwilling to wait tend to surrender their positions to those prepared to remain. The implication is subtle. A long sideways period can remove weak conviction without producing an obvious signal on any single day. The change happens through repeated transfer, not dramatic price action. So when you study a base, do not merely draw its borders. Watch how long it has forced traders to make decisions, abandon expectations, and exchange ownership. Then, when price finally gives you an entry, the next hidden signal may appear almost immediately, in the way the market behaves once your money is actually committed. The moment after you enter a trade deserves attention, because the market is now giving you information that did not exist before your order was filled. The setup may have looked convincing beforehand, but once you are committed, price begins testing that idea in real time. Suppose you enter expecting buyers to take control from a specific area. Instead, price immediately struggles. Each small advance is pushed back, and the market cannot produce the response that justified the entry. Nothing catastrophic has happened, but the behavior is different from what the setup implied. That difference matters. A trade should not be judged only by whether it has reached a loss limit. The first reaction can show whether the expected imbalance is actually present. If the market responds quickly in the anticipated direction, your thesis is receiving support. If it immediately meets persistent opposition, the quality of the thesis deserves another look. Can you observe that response without turning every small fluctuation into a reason to panic? That is the discipline. Immediate feedback is useful only when compared with a clear expectation formed before entry.